Have you ever wondered why governments keep printing money? Even though everyone knows it leads to inflation, it seems like a recipe for disaster, right? But in reality, countries often do it as a solution to bigger economic challenges. In this video, we'll uncover the surprising reasons why printing money is used, what effects it has, and why, despite its risks, it's sometimes the only option available. Stick with us as we break down the truth behind this complex economic phenomenon. The need to stimulate economic growth. When an economy is struggling, especially during a recession, governments may resort to printing more money as a way to stimulate economic growth. In times of low consumer demand and business investment, the increase in the money supply can encourage spending. By making more money available, the hope is that consumers will have more purchasing power, which in turn boosts demand for goods and services. This heightened demand can lead to more production, job creation, and business expansion, helping lift the economy out of stagnation. The extra money circulating in the system can help reignite economic activity and reduce unemployment, offering relief in challenging times. However, this strategy comes with risks. While printing money can temporarily boost the economy, it also increases the total amount of currency in circulation, which can lead to inflation. As more money enters the system, the value of each individual unit of currency decreases, and prices for goods and services start to rise. If not managed carefully, this process can spiral into high inflation, undermining the purchasing power of consumers. So, while printing money can provide short-term economic benefits, it must be done cautiously to avoid long-term consequences, like inflationary pressures that can harm the economy. Dealing with national debt. When a country has accumulated significant debt, printing money can appear as a potential solution to manage or reduce those liabilities. Governments may choose to print more money to pay off their national debt, especially when borrowing costs become too high or they face budget deficits. By creating more money, the government can use it to buy back its own bonds or settle other financial obligations, providing temporary relief from mounting debt. This tactic can be appealing in times of financial distress, as it seems like an immediate solution to a pressing problem without having to raise taxes or make cuts to public spending. However, while printing money may offer short-term relief, it can lead to long-term economic challenges. As the money supply increases, the value of the currency tends to decrease, contributing to inflation. The higher inflation can erode the value of savings and reduce the purchasing power of citizens. Moreover, excessive printing of money to pay off debt can lead to a loss of investor confidence in the country's economy and currency. This can cause foreign investors to pull back, leading to even higher borrowing costs and potentially damaging the nation's credit rating. Thus, while it might seem like an easy fix, printing money to deal with national debt can have serious repercussions that destabilize the economy in the long run. Hyperinflation and its causes. Hyperinflation occurs when a country's currency loses its value at an extremely rapid rate, often due to excessive money printing. Governments may resort to printing vast amounts of money to finance their spending during times of crisis, such as war, political instability, or economic collapse. While this may seem like a quick fix to generate more resources, it leads to a dramatic increase in prices across the board. As the supply of money grows without a corresponding increase in goods and services, the value of the currency plummets and hyperinflation takes hold. The cost of everyday items skyrockets and the economy is thrown into chaos. Countries like Zimbabwe and Venezuela are notable examples where hyperinflation occurred due to government policies that relied too heavily on printing money. The effects of hyperinflation are devastating for a nation. People's savings lose value rapidly, and wages become insufficient to keep up with rising costs. Basic goods become unaffordable, and the economy grinds to a halt as trust in the currency evaporates. People may resort to bartering or turning to foreign currencies as alternatives to the devalued national currency. In the worst cases, hyperinflation can lead to widespread social unrest, political instability, and a complete collapse of the country's financial system. While printing money may temporarily address a nation's financial needs, unchecked money printing can lead to hyperinflation, causing far more harm than good in the long run. Currency depreciation and trade balance. One reason countries print money is to intentionally devalue their currency in order to improve their trade balance. By increasing the money supply, a country can weaken the value of its currency relative to others. A depreciated currency makes a country's exports cheaper and more attractive to foreign buyers, which can help increase demand for goods and services abroad. At the same time, the weaker currency makes imports more expensive, reducing the demand for foreign products and helping domestic industries. This strategy is particularly useful for countries that are struggling with trade imbalances and want to boost their export sector without having to directly intervene in global markets. However, this approach is not without its downsides. While a devalued currency may improve a country's trade balance in the short term, it can lead to higher inflation. The cost of importing goods and raw materials rises as the value of the currency drops, which can lead to higher prices for consumers. Additionally, if trading partners perceive the currency depreciation as a form of currency manipulation, it could strain international relations and lead to retaliatory measures, such as tariffs or sanctions. As a result, while printing money to devalue a currency can boost exports temporarily, it also carries significant risks that can harm the economy and lead to inflationary pressures. Quantitative easing in modern economies. Quantitative easing, QE, is a monetary policy tool used by central banks in modern economies to stimulate the economy by increasing the money supply. In QE, central banks like the Federal Reserve in the US or the European Central Bank purchase large quantities of financial assets, such as government bonds, from the market. This process injects money directly into the economy, lowering interest rates and encouraging borrowing and investment. The aim is to boost economic activity by making credit more accessible and stimulating demand in the markets. QE is typically employed when traditional methods of lowering interest rates, such as reducing the central bank's benchmark rate, have already been exhausted, especially during periods of economic downturn or financial crisis. However, while QE can provide short-term economic benefits, it carries significant risks. The increased money supply can lead to inflationary pressures, as the value of the currency may fall with an oversupply of money. Although central banks may try to control this inflation by carefully managing QE, the process can create asset bubbles, where the prices of stocks, real estate, and other financial assets rise too quickly, leading to instability. Additionally, over-reliance on QE can lead to growing inequality, as the wealth generated by rising asset prices disproportionately benefits the rich, while the broader population may not experience the same gains. Thus, while QE is a tool for stimulating growth, it also has the potential for long-term economic imbalances if not managed carefully. Balancing inflation and economic stability. Governments and central banks face the constant challenge of balancing inflation with the need for economic stability. Printing money can provide short-term relief, but if done excessively, it leads to inflation, which erodes the purchasing power of currency. To prevent runaway inflation, central banks must carefully monitor the money supply and adjust monetary policies, such as changing interest rates or using other financial tools. The goal is to stimulate economic activity without allowing inflation to spiral out of control. Achieving this balance requires a delicate approach, where the government needs to gauge the economic conditions and make adjustments to keep both inflation and growth in check. At the same time, economic stability is critical for maintaining investor confidence and consumer trust. A stable economy encourages businesses to invest, workers to spend, and governments to manage their budgets effectively. While printing money may provide a temporary solution to an economic problem, long-term stability relies on building confidence in the currency and the financial system. Excessive reliance on money printing can undermine this confidence, leading to inflationary pressures, capital flight, or even currency crisis. In order to maintain economic health, governments must find the right balance between boosting growth, managing inflation, and ensuring overall stability in the financial system. In conclusion, while printing money may seem like a quick fix for economic challenges, it comes with significant risks, particularly in the form of inflation and instability. Governments and central banks must carefully manage the money supply to stimulate growth while avoiding the damaging effects of runaway inflation. The balance between economic growth and stability is a delicate one, requiring constant monitoring and adjustment. What do you think about the practice of printing money in today's world? Let us know your thoughts in the comments, and don't forget to like and subscribe for more insights into the complex world of economics.